All right, I have started the recording. If somebody could confirm for me that you can hear me.
We can hear you good.
Okay, good. I apologize after class last time I realized that somebody had been trying to say something and I couldn't hear it. It's the interesting thing about technology that had it set up, worked at 11 o'clock, I could hear people, didn't change anything, but then when I connected in this room, the sound setting was changed. And that wouldn't be too surprising if every time I connected in here, it changed the sound setting, but it doesn't. So why did it change it then and it didn't now? Anyway, I will, from now on, I will check every day to make sure that people can hear me and I can hear them. Okay, I have started the recording. Today we're going to continue in chapter 11. Thank you. It's been a long week. And partially because of the election. I'll just say one thing about the election that we have talked about, especially in macro, what is required for growth, for an economy to be productive. And a really important thing is institutions. Having institutions which create rules which are followed. They're not just on the books, but they are followed. And so I think it's really important that we not focus on, I mean, we're very interested in who wins the election, but we can't focus primarily on who wins. We need to focus on what are the rules. And we need to emphasize that the rules need to be followed. Whether the candidate you want wins based on those rules should be secondary. The most important thing is that that the actual rules be followed. Because if we don't follow the rules to get an outcome we like this time, well, you'll like the outcome in the short run, but the long run consequences of not following the rules are very bad. So
the Keynesian argument.
Yeah, you could apply it to the debate over what kind of economic policy the government should follow. Should they follow rules or should they use more of a discretionary approach? Rules are very important, and we'll see what the outcome of. We'll see two things: who wins, and we'll also see are the rules followed. They're both important. Okay. To review, we're talking about cost. We're interested in this chapter cost, and we're interested in the question of what does a firm have to do in order to not just make profit, but to make as much profit as possible. We will see that in a competitive market, we're looking at competitive markets in this chapter. In a highly competitive market, the firm has to do its best to maximize profit just to survive. And if you have a firm that doesn't do its best, in the long run, it's probably not even going to survive. Well, to understand what the firm needs to do to get maximum profit, we have to understand cost. We developed the idea of explicit cost and implicit accounting profit and economic profit. What's the difference between explicit cost and implicit cost?
See, the explicit cost is the cost up front, you can see it. The implicit cost is like an opportunity cost.
Okay.
You don't necessarily have to pay money for it, but it's going to cost you.
Right. For the implicit cost, it's an opportunity cost. There's no monetary payment involved with the implicit cost. You're talking about a resource that the firm already owns, so they don't have to go out and buy it, but there's a cost of using it because they could have used it for something else. They could have rented it out to somebody else, or the The owner could have used his time working for somebody else. And those implicit costs are relatively easy to forget about. They're important. They're just as important as the explicit costs, but they're relatively easy to forget about. For example, if you had if you are renting a building, then you have to pay rent. That's an explicit cost. And you're not likely to forget to pay the rent, because if you forget to pay the rent, what happens? First you have to pay a fee, and then you get kicked out. So you're going to remember the explicit costs. But if you are using a building that the firm already owns, you don't have to pay yourself rent every month. But there is an opportunity cost. You could be renting it to somebody else. And if maybe the opportunity cost goes up, so that before there really wasn't much demand for your building, but now you could rent it out for $10,000 a month. That's a high opportunity cost, but you may forget about it because you're not going to get a bill every month to pay it. And nobody's going to come and remind you, you gave up $10,000 because you didn't rent it to somebody else. So implicit costs are just as important, but they're easier to overlook and forget about. Accounting profit and economic profit, we'll be talking about those some today as we go through this. This is the example that I gave you 2 times ago. And finally, remember to send it out to you, but with email, but that was within the last hour, so you may not have gotten that. Anyway, here it is. We've got these different items that involve aspects of the firm's business to evaluate how this firm is doing. We have to figure out first, well, are these explicit costs? Are they implicit? Are they not costs at all? And then we can use that to calculate accounting profit and economic profit. And those are 2 different ways to assess how the firm is doing. And we'll just go through the utilities. Which would that be? Your electric bill.
Explicit.
It's going to be an explicit cost. If you don't, you have to make the payment. If you don't make the payment, they turn your power off. Labor services, wages.
Explicit.
It's going to be explicit.
Because there's people who will demand their feature.
That's right. If somebody's working for you and you don't pay them, they stop coming to work. So clearly that's explicit cost. Sales, revenue.
Implicit.
Well, that's not a cost at all. Right? That's just, some things are not cost. It's important, obviously. That's the dollars coming in, but it's not a cost. Here we're assuming that this is Emily's grocery store. We're assuming that she owns the building. She could have rented it out to somebody else and received $18,000. So what kind of a cost is that? It's going to be an implicit because she doesn't have to pay that to someone, but she is giving it up every month. Every month she should go to her mailbox and recognize, I could be receiving a check for $18,000 if I rented this building to somebody else, but because I'm using it for my store, I'm giving that up. Groceries, she's buying wholesale. Well, that's going to be an explicit cost. She's purchasing that so that she has inventory, which she can then use to sell to her customers. Taxes, clearly, it's going to be an explicit cost.
It's a dude with a gun shows up.
Yeah, if you don't pay your taxes, the guy with the gun shows up and takes you to expense paid vacation at government expense. Interest available on alternative investments, $7,000. Here we're saying Emily could have invested her money somewhere else, not in her business, but in bonds or stocks. And we're assuming that she could have gotten a $7,000 return. Is that explicit or implicit? It's going to be implicit because she's not having to pay that to somebody else, but she is giving that up. It is an opportunity cost of investing her funds in her business. Salary she could have earned elsewhere. That's going to be an implicit cost because she's not having to pay someone $50,000, but she is giving that up when she chooses to run her business. Then advertising is going to be explicit. You got to pay the bill, or whoever's doing the advertising for you stops running your ads. So here we have same thing where we've identified it, and here we have a statement which puts all the explicit together, all the implicits together. So we've got sales of 170,000. We've got total explicit cost of 100,000. We've got total implicit cost of 75,000, and explicit plus implicit are 175,000. So, given that, did she have a good year?
Accounting-wise, maybe.
We're going to get one answer, or at least a partial answer in terms of accounting profit. We're going to get a different answer in terms of economic profit. But that doesn't mean we're going to actually get a different answer in terms of was it a good year. Okay? We'll see in just a second. What is accounting profit? What's the definition?
It's the total revenue minus the explicit costs.
So important to have these relationships down. They're very easy to confuse. Accounting profit is total revenue minus explicit cost. The accountants are interested in how many dollars came in, how many dollars did we pay out. The opportunity cost of resources owned by the firm, the implicit cost, the accountants are not going to take that into account in calculating profit. So here, she's got $170,000 of revenue that came in. She had to pay $100,000. That was her explicit cost. So 170 came in, 100,000 went out. She has an accounting profit of $70,000. So she's more than covering her cost. So can we say, oh, clearly she should be happy. She had a good year.
Accounting-wise, she's in the black.
Accounting-wise, she did make a profit. But making an accounting profit does not mean you had a good year necessarily. Certainly, it's better to make an accounting profit than to have an accounting loss. But to know if she had a good year, you have to know something about her implicit cost as well. And we have seen that her implicit, total implicit costs were $75,000. So an economist would emphasize, would emphasize economic profit, which is defined as what? Total revenue minus total cost, which includes both the explicit and the implicit. Whereas the accountant would focus on 170 came in, 100,000 went out, so there was an accounting profit of 70,000. The economist would say, yes, but total cost included the explicit cost of 100,000 plus the implicit cost of 75. So total costs were 175,000. If you have sales of 170 and cost of 175, then you have an economic loss. You did not cover your cost. So we can say here that, did she cover her cost? Well, she covered the explicit costs. She did not cover all of her costs. Did she have a profitable year? Well, in accounting terms, she did, but in economic terms, she did not. So what does that really mean? I mean, it's just arithmetic there. But you want to understand, what does it mean to have a positive accounting profit, but a negative economic profit? And there's an important, this review, economic profit is total revenue minus what? Minus both. Economic profit subtracts all cost, all costs. Whereas accounting profit is total revenue minus what?
The explicit cost.
Only the explicit cost. Okay. We'll come back to the question I posed a moment ago, but what is the relationship between economic profit and accounting profit? In an equation, how could you write that? An equation that shows the relationship between these two. Where accounting profit is total revenue minus explicit costs. Economic profit is total revenue minus explicit and implicit. Okay. So you can write economic profit as accounting profit minus what? Minus the implicit cost. Okay. So this is a statement you want to remember because it shows you exactly what the relationship is between those two measures of profit. Accounting profit is always going to be larger because it's total revenue minus some of the cost. It's total revenue minus the explicit. Economic profit has to be smaller because it is total revenue minus explicit and then minus the implicit. So economic profit has to be a smaller number than accounting profit. You could turn that around. Accounting profit is economic profit plus implicit cost. Okay? You want to remember that relationship. Now let's go back. What does it mean to have positive accounting profit but negative economic profit? Well, let's look at this. The $70,000 accounting profit doesn't guarantee that the person is excited that they had a good year. What that means is they had more money coming in than went out. So if there's a positive accounting profit, that means they ended the year with more than what they started with. And that would also mean if you have a positive accounting profit, you're having no trouble paying your bills. You've got enough revenue to cover all of the bills you have to pay. So this firm could continue forever under these conditions. With a positive accounting profit of $70,000 every year, they can pay their bills this year, next year, forever. Okay? They're not going to be forced into bankruptcy. But you want to recognize that doesn't guarantee that she's happy. Doesn't guarantee that she believes that she had a good year or that this is worth continuing. Because, as in everything in economics, you have to look at all of the benefits and compare them to all of the costs. That's the recurring idea behind everything in economics. And accounting profit hasn't looked at the full picture. We said accountants don't go into the implicit costs because they're hard to calculate. But in reaching a conclusion, was this a good year or not? Could I have done better somewhere else or not? You have to take those implicit costs into account. And when we see that the accounting profit of $70,000 is less than the total implicit cost. So what that means is that when she looks at the results at the end of the year, she says, well, I was able to pay all my bills, and for all my efforts, for all the resources that I devoted to this firm, I made $70,000. But then she asked, well, but with the resources I devoted to this firm, what could I have done? And she could have invested her money elsewhere, earned $7,000. She could have rented the building to somebody else and earned $18,000. She could have worked for somebody else and gotten $50,000. So if she, instead of running her business, if she had used her resources elsewhere, she could have gotten $75,000. So even though at the end of the year, she did make $70,000, she ended with $70,000 more than she started with, she's going to look at this and say, I could have done better. If I had not run my firm and I had used those resources elsewhere, I would end the year with $75,000. So because she did not cover all of her cost, that's why her economic profit is negative $5,000. She could have done $5,000 better if she had, instead of running her business, if she had used those resources elsewhere. And we can say that if the only thing she's interested in is profits, and if she thinks the future is going to look like this year, then she will look at this and say, okay, I'm done. I'm going to go out of business. She doesn't have to, but she's going, because she can continue paying her bills as long as she wants, but she's going to choose to go out of business because she has a better use for her resources. And if she uses her resources elsewhere, then she will be $5,000 better off each year. Now, it's very possible, just as a footnote, that maybe profit isn't the only thing she's interested in. Maybe she really wants to run her own business. And if she wants to continue to run her business, even though she could do better elsewhere, that's fine. We're not saying that she would be stupid to do that. We're saying that if she's trying to make profit, if that's the goal, the only goal, then she will choose to go out of business, use her resources elsewhere, even though she's not required to do that. We tend to think of bankruptcy and going out of business in a very negative way. Obviously, if it's your business or your employer's business, the idea of going out of business is you don't get excited about that. We need to recognize that that's a necessary part of life in a modern economy, because businesses don't know exactly what the best products are to produce. So they have to take their best guess. They think, if I produce a certain product in a certain market, I think it'll be profitable, but they may be wrong. And if they start a business and it turns out people really don't want that product enough to cover the cost, then it is very productive for the business, for the owner to say, this isn't the best thing I can do with my resources. I'm going to choose to go out of business. We call that a failure, but it's really unfortunate that we do that, because failure is really a step to success. I think it was Thomas Edison, invented the electric light bulb, but it was after, like 1,000 attempts. So, he could have said, I had 999 failures before I had this one success. But he chose to look at it as, I'm going to try something, and if it doesn't work, well, that's a success in that I have identified this way doesn't work. Don't try that anymore. And I'm going to go on to the next thing. That's the same thing with trying to find a vaccine for the virus. Most of your attempts will not work, but you just keep going. It's the same thing in school. You may choose one major and you decide, this isn't what I thought, and I don't really like this. That's not a failure to decide to do something different. What appears to be a failure often can be a important learning experience that leads you to something much better. So Don't think of failure in negative terms, even though we all have a tendency, I know I do, to feel that way. I want things to go right the first time. It just doesn't happen. All right, moving on. What quantity to produce? Very simple question. You may think not a very exciting question, but it's really important to think through this, because there is an economic concept here that is so important. Marginal benefit, marginal cost. When you're just trying to decide what alternative to take, whether it's how many units to produce in a business, how many classes to take, how many degrees to get, how long to spend reading a particular subject. You compare, if I spend an extra hour doing this, what are the extra benefits? What are the extra costs? That comparison is just so fundamental to so many issues. If you don't think in those terms, then you just kind of go with, well, it feels like I ought to do this or that. And much better to try to think about what is the marginal benefit, what is the marginal cost. This is one application of that. Yeah.
In the equation, profit equals pi equals total revenue minus total cost. What is pi necessary, or is it just?
No, that's a good question. The Greek symbol pi is a symbol that economists like to use to represent things. In macroeconomics, we use it to represent inflation. In microeconomics, we tend to use it to represent profit. Okay? And why? Because it's much easier to write pi than to write P-R-O-F-I-T. Okay, so it does not mean 3.141 whatever. It's not the mathematical value. It's just we're using it as a symbol to represent profit. So don't let that throw you. Profit, which we're going to represent with pi, as we said before, is defined as the difference between total revenue and total cost. Profit and revenue are not the same things. It seems basic, but I find people really forget that. They have trouble remembering that profit and revenue are fundamentally different things. Total revenue is price times quantity. As long as we're talking about a firm that is selling everything at one price, it's not price discriminating, then revenue is very easy to calculate. It's the price per unit times the number of units that will be sold. And remember, we are talking in this chapter about competitive markets. Just to review a little bit, we said that we're going to look at 4 different types of markets. First is competitive, where firms are price takers. Each firm is a very small part of the market. So each firm says, what I do doesn't matter to the price. Whatever the price is, whether I produce a lot or a little, it's not going to change. So in the types of markets we're looking at, until we get over to chapter 13, we will be dealing with price taker markets, where they just look out and see what is the market price. That's what they have to charge. And then total cost, remember we said that it's just fixed cost plus variable cost. Fixed those costs that did not vary with output, variable those costs which do. We're interested in the question, at what quantity will profit be greatest? And a lot of people look at that, think, what could be more boring? But if you work for a company where they don't know how to think about this, they're likely to produce the wrong quantity, and they're likely to lose money, and you're likely to be unemployed. So knowing how to think about this question can be the difference between surviving in a market and not surviving. Think about it like this. It's not just a question for the exam. Firms in the real world need to know how to think about these things. And here we have a cost chart from your book. Look at this very carefully. And there are a lot of numbers there. You can get lost in all of these columns. So look at it, just take 15 seconds, look over when you are given data, look over the column headings, think about what those are, then look down the rows, see what happens. If you just glance at it, you're not going to pick up what's there. So always, especially on an exam, look at it, think about it carefully. So what do we have? Well, barrels of oil produced. Well, this is the quantity. We're trying to figure out what quantity is going to give the firm maximum profit. I really wish they hadn't identified it here, but I couldn't find a way to get rid of it. So just ignore the red. Ignore the red for now. Second column is total revenue. Okay. Total revenue is what? It's the price per unit times the quantity. No doubt on the exam there will be a table like this that will ask you a number of questions. So think of a table like this as the key to going through this course once rather than twice. Okay? You don't want to do the course twice. And if you don't understand tables like this, you'll get to do it more than once. Okay, so here, total revenue, price times quantity, that's just what we talked about before. Total cost, well, that would be the sum of the fixed and the variable. Profit, difference between total revenue and total cost. Marginal revenue, we haven't really defined that yet. We'll get to that in a second. Marginal cost, okay. Marginal always means extra. So marginal revenue is going to be the extra revenue you get from selling an extra unit. Marginal cost is going to be the extra cost in producing an extra unit. Marginal concepts are harder for most people to grasp than averages. Okay? When you get it, you really want to do marginal analysis well, then you have to get into calculus, which most people want to avoid like the plague. And even Adam Smith did not understand marginal analysis. It was 100 years later before economists figured out the marginal idea, and we had what was called the marginalist revolution, because that idea was the economist who came up with it realized, wow, this applies to everything. And let's see. So notice as we move down the chart, we're talking about what happens if the firm produces larger and larger quantities of output. Okay? And you can see when they produce the first unit, total revenue goes up. Not a big surprise, goes up to 50. Produce the second unit, goes up to 100. Third unit goes up to 150. Where's the 50 coming from? The price. We are assuming that we're looking at the market for oil. We're assuming that we're looking at a stripper well, which is very small. So the owner of that stripper well says, I'm producing less than 10 barrels a day. The world market is 82 million barrels a day. Nothing I do is going to affect the world price. So you've got the overall oil market, the world oil market, determining the price. We're assuming it's 50. And so the individual firm then says, okay, well, if I want to, doesn't matter how much I produce, I have to sell each barrel at $50 per barrel. He could sell it for less than 50, couldn't he? I mean, would he have any trouble selling it for $40? No, but that would be incredibly stupid, because if he can sell as much as he wants at 50, why would he cut the price? He wouldn't. In a competitive market, you're never going to see the price being cut, because the firm can sell as much as it wants at that market price. And so total revenue becomes just a multiple of the price, 50, 100, 150. Every time the firm produces an extra barrel, revenue goes up by the amount of the price, which takes the definition for marginal revenue, MR, the change in total revenue from selling an additional unit. Here's the definition in more mathematical terms. Delta means change. MR is the change in total revenue over the change in quantity. It is the additional revenue that the firm gets from selling an additional unit. Okay? And this is the definition of marginal revenue. And that will be true for every firm. Doesn't matter what kind of market we're looking at. That's just the definition of marginal revenue. This will not be true for every firm. This is true only for price taker firms. Okay? MR equals price. Think about why that is. Marginal revenue is the extra revenue the firm gets from selling an extra unit. Well, since the firm is a price taker, every time he sells an extra unit, he brings in an extra $50. So MR is very simple in a price taker market. It is just equal to the price. Okay? So remember that this is true, but only for price taker firms. When we get to monopoly and oligopoly and monopolistic competition, MR will still be the change in revenue of the change in quantity, but MR will no longer be equal to the price. It'll be a little more complicated. All right, so now we understand why total revenue increases by 50 every time every time an extra unit is sold. Notice total cost. If the firm produces no output, total cost is $30. What does that tell you? The firm has some kind of cost that it's going to incur even if it doesn't produce any output. As long as it stays in business, it's going to have this cost. In some cases, you would have insurance, where you're insuring your building. Well, if you choose to go out of business, then you can drop your insurance coverage. But as long as you're in business, even if you decide to not produce anything this month, you still have to pay that cost. And how much you produce has no effect on what your insurance is going to be. So the 30 there tells you that this firm has fixed costs of $30. And then when it produces the first unit, total costs go up to $34. Okay? So what we're really interested in is over here, marginal cost, which is defined as the change in total cost from selling an extra unit, or this is the extra cost the firm incurs when it chooses to produce an extra unit. It's very easy to say that definition, but people really have trouble grasping that definition, which is why calculus wasn't invented until the 17th century. And then even after it was invented, it took another 200 years for economists to figure out, oh, this is what we need. It's the extra cost of producing an extra unit. So we see when the firm produces that first unit, total cost goes from 30 to 34. So what's the marginal cost? 4. And that's why you got there, okay? Produce the second unit, total cost goes up to 40. What's the marginal cost of that second unit? That's going to be 6 because you went from 34 to 40. The extra cost was 6. And notice as the firm continues to produce more and more, not only does total cost continue to go up, and that's not surprising. We would be really surprised if you could produce more and your costs went down. That would indicate something, your numbers are wrong, because if you're going to produce more, then your costs are going to have to go up. But total cost at some point starts to increase at a faster and faster rate. We see that when we're producing the low levels of output, marginal cost, yeah, it's positive. You produce the first unit that costs $4. Produce the second unit, the marginal cost of that one is 6. Okay? So cost is the second unit has a higher marginal cost than did the first. The third unit has a higher marginal cost than the second, and so on. As the firm is producing more and more output, not only is the total cost going up, but the marginal cost is going up as well. There are some situations where the marginal cost could actually decline for a period, but eventually marginal cost is going to start to go up. Yeah.
What was the marginal cost? It was NC equals, it was on the slide before this one.
You talking about this one?
Yep, and then there was an equation.
Actually, I think this was, this is it, okay? Marginal cost is defined as the change in total cost over the change in quantity. Okay? Just like the marginal revenue is the change in total revenue over the change in quantity. Marginal cost is the change in total cost over the change in quantity. You need to remember that equation, but even more importantly, you need to understand what it represents. It's the extra revenue the firm gets from selling an extra unit. It's the extra cost the firm incurs when it produces that extra unit. Okay? And that we see here these numbers as the firm is producing more and more. Total cost continues to go up and marginal cost is going up. That second unit, the marginal cost of it was only $6. But you get out to the 7th unit, the marginal cost of it was $36, far higher than those earlier units. Okay? So a couple of things to notice here. We have different ways of measuring cost. You probably thought, well, cost, that's, how could it be that complicated? We've already seen you've got fixed cost, variable cost, implicit cost, explicit cost, sunk cost, got all these different measures of cost. And if a firm doesn't understand these things, then they're likely to make bad decisions. I would suggest to you that if you talk to a business owner who is successful, if he hasn't had any economics courses, he may not be familiar with these terms. But I would suggest if he's successful, he understands the concepts. Some people can figure it out on their own, and they don't need the term, they've got the concept there. But a business that doesn't understand the concept is going to make some bad decisions. So notice here, we've got Marginal revenue remains constant. Every time it produces an extra unit, marginal revenue goes up by the price, and that's constant. Marginal cost starts out low and gets higher and higher and higher. The principle that is key is what we have here. To maximize profit, what does the firm need to do? It needs to keep producing as long as marginal revenue is greater than marginal cost. Analogous to, you go into a pizza place where pizza is $1 a slice. How many slices do you eat? Well, you think about the first slice, you say, what's that worth to me? And if you think it's worth $5, I'm hungry. It costs $1, you buy it, you eat it. After you eat the first one, probably not as hungry. Second one's not worth as much to you. So you're comparing what is the marginal benefit from that second slice of pizza. Compare that to the cost of the second slice. And if it's worth more than it's going to cost, you eat it. And you just continue to apply that logic. You look at each unit, say, is it worth more than the cost? And if you continue doing that, eventually the value of another slice gets lower and lower. Eventually you look at the next slice and you say, you know, maybe I would enjoy another slice, but it's not worth $1 to me. So you stop at that point. Just like we talked about efficiency. We want to produce every unit that produces a benefit to society greater than the cost of producing it. Right? It's the same principle. We're just looking at it in different places. And here we're looking at it in terms of the firm's decision about how much to produce. It's going to look at, if I produce that first unit, what does it add to my revenue? What does it add to my cost? If it adds more to the revenue than to cost, then you want to produce it. And then you look at the second unit and you ask the same question. And the third and the fourth, you keep increasing output as long as MR is greater than MC. But what did we see? We saw that as the firm expands output, marginal revenue stays the same, but marginal cost gets higher and higher. So for the first unit, adds $50 to revenue, $40 to cost, or $4 to cost. So profit goes up by $46. Does he want to produce that? Yeah, he wants the $46 of profit. So he goes to the second unit. Is it worthwhile to produce that? It's going to add $50 to revenue, $6 to cost. So it's going to add $44 to profit. Does he want that extra $44 of profit? Absolutely. Okay. Now you could say, well, but isn't 46 better? Okay. Well, he would like it if the second unit added 46 too. Okay. But it's not either or. Okay. He's going to produce that first unit because it adds something to profit. He's going to produce the second unit because it adds something to profit. Okay. When we say he's going to produce every unit that adds more to revenue than to cost, that's equivalent to saying he's going to produce every unit that adds anything to profit. And so he's going to produce the second unit because MR is greater than MC. Third unit, the same, he's going to produce it, go on to the next. Yeah, all of these are going to add to profit, but each one is adding a smaller amount to profit. We get to the seventh unit. Sells it, it brings in $50 of revenue, but it costs $36 to produce it. So it adds only $14 to profit. Does he want that profit? Absolutely. Just like you're walking down the sidewalk, you see $14 laying on the sidewalk. Are you going to pick it up or not? You're going to pick it up. That's what he's going to produce that unit. And then he goes on to the next. looks at the 8th unit. The marginal revenue is 50. The marginal cost is 50. It's going to add the same amount to his cost that it's going to add to his revenue. So that last unit doesn't add anything to his profit. So to be perfectly precise, we would have to say he's indifferent between producing that last unit and not producing it. It doesn't reduce his profit, but it doesn't add to his profit either. Our convention is going to be to say if he's indifferent between producing it and not producing it, he'll go ahead and produce it, because it would be a little awkward to every time say, well, he's going to stop one short of where MR equals MC. Okay, now he's going to keep going as long as MR is greater than MC, and that means he's going to end up where MR is equal to MC, and that is where he's going to stop, because that is where his profit is going to be at a maximum. Notice he could continue producing. He could produce 9, 10, even more, and his revenue would continue to go up. If he's looking at revenue, you can get an extra $100 by producing the 10th barrel. But those last 2 units would add more to cost than to revenue. And so his profit would go down. He wants to produce every unit that adds more to revenue than to cost. He doesn't want to produce any unit that adds more to cost than to revenue. So he doesn't want this, he doesn't want that to happen. He's going to stop on that last unit where MR and MC are exactly equal, which means he's going to stop where he's producing 8 units. His revenue is going to be 400. His cost is going to be 206. And that means his profit is going to be 194. Notice if he had stopped at 7, his profit would still have been 194. Shouldn't be surprising, because we've already seen that that very last unit didn't add anything to his profit, but all of the previous units did. Notice as he was expanding out to 8, profit continued to go up until he got to the 7th unit, and then the 8th unit didn't add to it or take away from it. So he stops at that point. He's not going to produce the 9th or the 10th unit. Notice he's not producing as much as he can. He's not going to sell as much as he can. Okay? He's trying to figure out what is the quantity that will give me the most profit. Okay? And we have a very simple conclusion. It's going to choose to produce where marginal revenue equals marginal cost. Okay? We have a lot left to cover in this course, but nothing will be as important to remember as MR equals MC. Okay? If you're looking for something useful to tattoo on yourself, MR equals MC. That will help you in any economics course that you take. Okay? So, and it will it's a secret code that other people who know economics will say, hey, I know what that means.
That person's obviously a crazy person, or they paid attention.
Yeah, that person obviously a crazy person, or someone who paid attention, or could be both.
Two things can be true at the same time.
Okay. Self-check. Competitive firm will maximize its profit at the quantity where MR equals price, MR equals MC, MC equals 0. It's going to be B, where MR equals MC, but these others are useful to think about. Will MR equal the price? As long as we are talking about price taker markets, then absolutely, marginal revenue will equal the price. Go back to our chart here. Marginal revenue, 50, 50, 50, 50. As long as it is a price taker market, a competitive market, marginal revenue will equal price. But notice what the question says. A firm will maximize its profit at the quantity. This does not identify any particular quantity. If it's a price taker market, MR is equal to the price for the first unit, second unit, for every quantity, MR and price are equal. That's important to understand. For a price taker market, MR is the price, just because when they sell another unit, revenue goes up by whatever that price is. Right? They don't have to cut their price. We'll see in the other type markets where they do have to cut the price, then marginal revenue will turn out to be below the price. But we don't need to talk about that yet. And let's think about, for a moment, MC equals 0. Would the firm like its marginal cost to be 0?
Yes.
Firm would like all of its costs to be 0. That would be great. But it's not a question of what they would like.
What the reality is.
Yeah, what is the reality? The firm is going, we assume the firm is going to do everything it can to whatever quantity it produces, it will produce it in the most efficient way, which means it will produce it at the lowest possible cost. Right? But the firm is not going to choose to produce where MC equals 0. That's not, the goal is not to get MC equal to 0. The goal is to maximize profit, and that is achieved by producing where MR equals MC. We're going to have a number of things. Soon we'll be talking about average cost and average variable cost. So we'll have a number of different things that can get confusing. The most important thing, if you're asking the question, what quantity will give the firm maximum profit, it's very, very simple. MR equals MC. We will have some graphs that are very complicated. But if the goal is to figure out what quantity will give maximum profit, you only have to do one thing. You say, okay, at what quantity is marginal revenue equal to marginal cost? Don't get distracted by other things. On a question like this, the principle that is relevant is very, very simple. You want to maximize profit. How much do you produce? You produce where MR equals MC. Nothing else matters. Okay, this is another way of making the point. Here we have the same information, but we're presenting it in a graph. Notice, again, anytime you look at a graph, spend some time really taking in what's there. We've got the quantity. Notice we're looking at one firm here. This is not the whole market. Not the whole market. This does not show how the price is determined. The price in a competitive market is determined by overall market demand and overall market supply. We've already assumed that the market price is $50. This firm is taking that $50 price as a given, which means this firm says, I can produce one unit, one barrel, and sell it at $50 per barrel. or I can produce 2, or I produce any quantity I want, it's not going to change the price. Why? Because I'm such a small part of this giant market. So the price line is going to be completely horizontal. You could say that this horizontal line represents the demand for the output produced by this one firm. Okay? Notice it's horizontal, which means perfectly elastic,
There's a lot of alternatives.
because consumers have a lot of alternatives. They can buy from lots of other producers. So this firm says, no, I can sell as much as I want as long as I charge the market price. If I charge $50.10, I won't sell anything. And to sell at a lower price would be stupid, because I can already sell as much as I want at the market price. So you've got, that is the demand curve, shows you the price that the firm will get for each unit that it sells. Notice that horizontal price line is also the marginal revenue line, because for every unit that it sells, what's it going to bring in? It's going to bring in $50. Okay? And we've got the marginal cost curve, which, as we saw before, it starts out low, and as the firm expands, marginal cost goes up. This book doesn't really go into much detail on why that happens. The book I used to use had a whole chapter on why the marginal cost curve is upward sloping. It has to do with the law of diminishing returns, that as a firm increases its use of variable inputs for a fixed amount of the other inputs, eventually marginal product declines. And when marginal product declines, marginal cost goes up. I'm not going to ask you anything about that, but that's the reason for it. The marginal cost curve is upward sloping because of the law of diminishing returns. That was touched on in chapter 28 in macro, if you recall that. Okay, so we've got the upward sloping marginal cost curve. We've got the horizontal demand curve, which is also an MR curve, which is also the price line. How much is the firm going to produce? Well, as we said before, it's going to produce for every unit. It says, is this worth producing? First unit will add $50 to revenue, very small amount to cost, so it's going to produce it. Goes to the next unit, adds $50 to revenue, much less to cost, so it's going to produce it. Follows the same logic, continues to produce more and more, and because of the law of diminishing returns, marginal cost continues to go up. And that means the extra profit on each extra unit is getting smaller and smaller. But the firm expands all the way out to 8, as we saw before. Because once it gets up to 8, then we're here, and that means marginal revenue and marginal cost are equal, which we already saw from our table, where MR equals MC is the quantity that will give the firm maximum profit. So we're seeing exactly the same idea. It's just that we're illustrating it with a graph, whereas before we were using numbers. When the firm gets to 8, profit is going to be at a maximum, because that's where MR and MC are equal. If the firm stops short of that, then you would have these units which would have added to profit, but he's going to lose that. Kind of analogous to the dead weight loss if we don't produce as much as the efficient output. Different, but kind of similar. If he produces way out here, then that's not going to maximize his profit, because he's producing some units that add more to cost than to his revenue, so his profit starts going down. Doesn't want to be out here, doesn't want to be in here. What does he want to do? He wants to produce where MR equals MC. That gives him maximum profit. Now consider, what if the market price increases? Let's say that this is the world oil market at one point in time. Equilibrium price is $50. Something happens that causes the demand for oil to increase. People want more of it. Are oil producers, are they very charitable people, and because the demand for oil went up, they say, oh, consumers want more, we'll pitch in and we'll try to help? No, I wouldn't count on that. But they are going to respond. And what this is really, really important. This shows you how, when you have producers, even if they don't care about the customer, if they care about profits, then they will respond to a change in consumer demand. Here, consumers want more. That increase in demand pushes the price up from $50 to $100. Now, notice what happens. The firm, remember, we're looking at one individual firm. The overall market is made up of thousands of firms. We're looking at one representative firm. And we already concluded that this individual firm gets maximum profit by producing 8 barrels per day. And it's not in his interest to produce 9 or 10 or any more. He's producing exactly the quantity that gives him maximum profit. Why? Because 8 is where MR equals MC. But when consumers change their demand, that change in consumer preferences is reflected in a higher price. And when the price goes up, the price line goes up, and that means the marginal revenue curve goes up. So whereas 8 was the profit maximizing quantity before, when the price goes up, MR is now up here. And so the firm looks at the 9th unit and says, well, if we produce that unit, our marginal cost is here. And previously they said it's not worth it. But because the price is higher, now the marginal revenue from producing that unit is higher. Now the firm says, okay, price is higher, we are going to produce that extra output. They are responding and giving consumers what they want. People want more oil. The producer is going to give the consumer more oil. Okay? Not because they care about the consumer. Now, in a perfect world, they would care about the consumer, but that's not why they're responding. They're responding because it is now profitable to produce that 9th, to produce more output. And we would say they were producing where MR was equal to MC. That was right here. But because demand has gone up and the price has gone up, marginal revenue has gone up. And so MR is now equal to MC here. Okay. Firms are producing more. They are responding to the signals that the price is communicating to all of these producers in the market. Notice the consumers, they don't have to, or the producers don't have to know anything about who wants this extra output. Okay. All they have to do is look at the price. When they see the price go up, they can say, what do we want to do? We want to produce where MR equals MC. Higher price means they now want to continue producing until the marginal cost of the last unit is $100. Okay? Firms are, this shows that the incentive that firms have to respond to changes in consumer behavior as they are reflected in prices. If price increases, a firm will, what did we just see?
Increase in production.
A firm will expand production. Okay? If the price goes, if consumers want the product less, the price will go down, and each individual firm will have an incentive to cut back on output. Yeah.
With that price increase, would that have, I might have gone ahead in the chapter 12, but with that price increase, would there be an increase in firms to take advantage of that increase in price?
Would there be an increase in the number of firms?
Yeah.
The question is whether this price increase would lead to an increase in the number of firms. What we're showing here is the short run effect. We assume that it takes time for new firms to enter. Okay? So what we're seeing here is that when there's an increase in demand, the price goes up, the existing firms expand output. Okay? Next time we'll see that as a result of that, production in this market is going to become more profitable. And when it becomes more profitable, you're going to have firms that are not in this market who are going to say, hey, they're making a lot of profit there, and you're going to have entry into this market. So in the long run, output goes up partially because the original firms expand, but partially because new firms come in and start producing. But in the short run, it's just going to be the existing firms producing, come in. Okay, next time we will start talking about average cost curves. Doesn't sound that exciting, but it's important. We'll see the relationship between profit and average cost. We'll be able to derive the supply curve for an individual firm and for the market. And we will go through an example that will show, I think very well, how the invisible hand works in a competitive market. And we're going to get the end result that when you have a competitive market where all the firms are doing everything they can to make as much profit as they can, they end up making zero profit.
That's a totally different kind of zero from an accounting zero.
They end up making zero economic profit, which is counterintuitive. Their goal is to make as much profit as possible. So where do they end up? They end up making zero profit. That's something that a lot of people never appreciate about markets, but it means that consumers get a really good deal. Okay, let me know if you have questions.